Hey everyone, I am very excited to have a multi-time guest back with us. Kyle has been part of our content now probably for the last 8 years, which is crazy. I first met Kyle when he was at OpenView. Kyle is a pioneer that helped start the SaaS benchmark survey back in 2017. Visible is one of the early partners there, and it lives on today, and we're still part of it, which is great. Kyle has since founded Tremont. He's based in Boston. Tremont's focused on growth equity and the B2B SaaS space. And you've probably seen some of his writings as well with Growth Unhinged. It's a newsletter really just focused on all things SaaS growth, over 70,000 subscribers. I think recently I saw some sort of post, Kyle, about we have enough subscribers to fill Fenway now, which is
I
pretty
think,
awesome.
yeah, maybe even a couple times over at this point. It's
Maybe we
wild.
can have an open mic night and sell it out. Talk all things SaaS at Fenway.
The most boring event at Fenway Park.
Well, thanks for joining, and appreciate you taking time to chat with us today.
Yeah, thanks for having me on.
Cool. Let's start with benchmarks. That's how we first met. We are still help powering some of that survey today. Kind of just first question, as an investor, like how do you think about benchmarks? Are you using them to help inform investment decisions? And then like maybe kind of a follow up. Do you find benchmarking evolving based like the current market conditions? Like you're seeing some of these companies now hyper scale. We were just talking about Pylon right before we jumped on, signing 30 new clients a month per AE, which is kind of crazy. So, yeah, I'll hit pause there, but just let it get kind of kick things off, talking about benchmarks.
Yeah, well, so I kind of decided to start the benchmark report back in 2017, more on the operating side rather than the investing side, if I'm being honest. We were just getting so many questions from the portfolio around, hey, how much should we plan to grow next year? What's a reasonable amount to spend on marketing as a percentage of net dollar retention for a company selling with my kind of deal size? Just all of these questions about team structure and ARR per employee and all of these things that, everyone both wanted to know, hey, is what they're doing healthy? But, more importantly, where they should invest, where they should pull back, how efficient should they be, and just getting some external validation around their plan relative to the market. And so decided to launch it more for that angle, honestly. From an investing standpoint, what's difficult about benchmarks is that you're always looking for the outliers to
Hmm.
invest in. You don't want to invest in average. And so you're actually kind of definitionally looking for people that are at the kind of top end of the benchmarks, or at least they spike in a certain area, even if not everything's figured out. And so even if the benchmark for a typical growth rate or a typical efficiency profile or net dollar retention, even if that changes year in and year out, our definition of what's a great company to invest in doesn't necessarily change.
Yeah, absolutely. What about like where are we at in terms of like what's in right now in terms of some of these like metrics and benchmarks? We went from like hyper growth in the ZERP era to efficiency metrics like investors talking about things like ARR to employee and Rule of 40. Like now it seems like things are kind of getting back into the growth phase. Like where are we now in 2025 when it comes to some of the metrics people are gravitating towards?
Yeah, we don't really love balance in this industry, do we? Or it feels like the pendulum is constantly swinging from one thing to the next. I guess I think we're in an odd place right now, right? If you look at some of the companies that are getting funded right now, particularly by multi-stage funds, they're getting a lot of money relatively early in their company history and very early in terms of the number of employees. But part of that's because some of the breakout companies are growing faster than we've ever seen them grow before. I mean, you could look at businesses like Cursor, which had such an insane path to 100 million ARR and beyond. In the newsletter, I feature businesses like Lovable, but then there's also Bolt, and there's a host of others that are getting to 50, 100 million ARR with relatively lean teams and in just such a fast pace. And it's often a combination of all of the interest around AI plus having a product that can be bought self-serve or with some sort of product-led angle. Uh, And yeah, just it's a kind of fascinating time right now. But for most of the market, I mean, while that's probably what's getting the headlines and people are so interested in these growth stories, for most of the market, it's actually a pretty challenging time to fundraise. Q1 in particular, looking at some of the carded data, was relatively light in terms of fundraise environment, particularly around seed and Series A. Uh, Valuations were kind of reasonable in terms of historical averages, so pretty normal, but the number of deals is fairly low. And so what I think is there's a bifurcation in the market. And for the folks that are on the venture track, especially if they're raising from large multi-stage funds that might have a $10 billion fund, there's a lot of pressure to grow as fast as possible to kind of be on that leaderboard. And now that folks have seen what's possible with the cursors of the world, that's kind of the expectation. And then there's kind of everyone else. And I'd say for that everyone else bucket, we're really trying to balance growth and profitability. Doesn't get talked about as much, but we're often trying to manage as close to cash flow break even as we can and use AI and automation to make there be less of a trade-off between growth and profitability as there used to be. Sort of
Hmm.
now the like how fast can we grow assuming we want to be as efficient as possible. And that I think is new, or relatively new, because people are realizing that maybe instead of having a customer support team with 5 people, they could do with 1 or 2 people plus AI, or maybe they could take a lot of the SDR work and automate it through signal-based tools or AI SDRs even, or tools like Clay. And so I think there's a big focus on essentially trying to find that right balance, which is going to be very different for every company, and just to find ways to make their operational processes more efficient because increasing headcount doesn't necessarily translate into growth like it used to, and many businesses don't have the kind of balance sheets and the capital available to kind of keep being on this venture treadmill, if you will.
Yeah. How can founders use, kind of pulling that a little bit, benchmarks as like a calibration tool rather than like a blueprint, right? Like you mentioned, like we don't love balance in this industry, but it's hard, right? If 1 second you're hearing and from investors and reading the news, you're like, oh man, I need to grow, 1,000% this year, and then all of a sudden the next day it's, hey, what's the rule of 40? You're like, what? So I guess like how can I as a founder kind of run that through my own model and use it as calibration. Like, what should I tune into versus not as I build my company?
Yeah, so I think the first thing is understand what's going on in the broader market. And so, you're not necessarily immune to macro trends. Oh, if there's a slowdown in buying behavior and that's affecting, public companies, but also down to kind of private companies and your peers, that's something you want to know now, because if you're trying to ramp up your go-to-market spend, for example, but no one's out in the market buying, and it's just a much more challenging macro environment, that's something that you should know in order to just help you plan the business. And then otherwise, I think it really helps people see what the strong suits are for their business that they could double down on. And then also, what are some areas of, where they're not at the benchmark? And is it worth actually doing the work to get closer to benchmark because there's a gap there? Or is it actually a better move to double down on your strengths? So, for example, I'll talk to a number of companies that have a CAC payback period that's much better than expected, right? But they have artificially constrained some of their sales and marketing spend. And for those companies, it's, hey, look, you're sub 12-month CAC payback period and actually have a very healthy net retention. You're growing at, maybe a profitable rate, but what would happen if you ramp up spend in sales and marketing? And it looks like you have the efficiency to really support that. But then for other companies, it might be, hey, you've got a 24-month CAC payback period. That's much out of line relative to our space where we're selling into. It's going to be really challenging to continue investing at that level. What can we do to make our go-to-market more efficient? I think on the net and gross retention side, that's where a lot of attention has been paid lately, particularly as people see this phenomenon around AI tourists and adopting new or launching new products that demo really well, but then retention is certainly not where it was in kind of traditional SaaS.
Mhm.
And so folks are thinking about how to find the right target customers that do retain at a higher rate, how to bundle software and AI so that that kind of balance is really still efficient, and just to find ways to change their go-to-market strategy to make sure they're doing things like getting people on annual plans rather than monthly plans, or just making sure that they have the right customer success practices in place so they're not losing folks just by not having a great onboarding experience or what have you. But it's more about a diagnostic, right? As opposed to an actual playbook or telling you what to do. But I think that diagnostic is really helpful, especially like I wouldn't look at benchmarks on a weekly or daily basis. I'd look at it, quarterly, maximum monthly, as just a reset, just to better understand your business and kind of look outside of the day to day to kind of look and see where you are.
Have you ever seen cases where founders leaned too heavily into the diagnostic in the benchmark, or maybe they lost uh, something they were great about or great with, and they leaned too much into that?
I mean, there's definitely a number of examples of that. I mean, I see a lot of examples, for example, with like free to paid conversion rates.
Mm.
And some folks are below the benchmark on free to paid conversion, and then they start maybe thinking, hey, we're so low on this metric, we've got to, double, triple conversion. But it's really they just had a really great and efficient acquisition funnel, or they had some interesting viral loops that attracted a low intent audience, which was fine. And so you don't necessarily need to move to like having a credit card gated free trial to artificially drive conversion up, because actually that's going to send all of these potential users away. They're not going to sign up in the first place. So I think like over indexing on a certain metric or trying to move that metric in isolation when it doesn't really fit the context of your business, it doesn't improve, ultimately revenue and lifetime value with your customers. I think that's the mistake that happens a lot. And each business is going to have its own distinct revenue model and way of growing. And looking at averages ends up kind of making you default your business to what's normal or average, as opposed to building something that's really different in a positive way from everyone else.
Love that. We talked a little bit about AI already and in the rise of AI. Any new metrics that you're seeing people track that call it outside the norm, or anything new emerging? We talked about some of the headcount efficiencies you could get with SDRs or customer support, but any other um, metrics you're seeing people think about or integrate into their either into their internal part of their business, right, or external part in their offering?
For sure. Uh, yeah, I mean, I would say the first thing, ARR per employee, or ARR per FTE, full-time equivalent employee, to me, that has gone from something that like no one really looked at or talked about to then a couple of years ago, it started to be something the CFO would look at or the board would ask for. Now it's become this like flex, and you even see like lean AI leaderboards popping up online, or like viral posts about how this company hit this revenue with this employee count. Everyone's trying to be the first like single employee unicorn. So that's been really wild, is to see that become more of this like badge of honor across companies. Hadn't seen that before. But other things, I mean, gross margins are, that's always something that we looked at in software, but we almost took for granted. We kind of just said, hey, most businesses have software like gross margins, usually 80% plus, but at least 70% plus. With AI, some businesses have negative gross margins or have very unpredictable gross margins at the customer level. And so that margin piece is just much more important for both the companies and then also for investors to say, hey, is this actually a sustainable business here that will be profitable at scale? And then I think the final one I would just say is like the definition of ARR is being really challenged right now. And ARR is the bedrock of benchmarks. So by ARR, I mean annual recurring revenue. typically, if we sold subscription plans and had mostly annual contracts or maybe multi-year, had high retention rates, we could feel pretty confident that once you closed a customer, they would renew, and this would be pretty predictable subscription revenue. And so, a lot of the benchmarks that we look at are just tied to this concept of ARR being really high quality. And even things like how we value software businesses, it's based on, current and next 12-month ARR multiples, not EBITDA multiples, for example. But in AI products, there's a lot of experimental revenue from folks piloting products, but they're not in production. Many folks are counting that as ARR. There's also usage-based or success-based revenue streams, which are sometimes not as predictable as traditional ARR. But then you also see annual deals with a 3-month opt-out where 70%, 80% of people are actually taking that opt-out. So it's not really an ARR. It's more of like a pilot. You've just
Yep.
sold it as ARR. And then there's fintech revenue streams, right, with payments and other things that have different margin profiles than classic software ARR. And so I think the big thing is if that's the foundational building block of a lot of metrics, and we can no longer trust that what one company says is ARR is what another company says is ARR. I think that's like the biggest fundamental challenge that I see right now, and that a lot of people are either thinking about or should be thinking about.
Kind of related, directly related to that, you've done a lot of work on AI and pricing and how people are experimenting with pricing. Intercom, I think is, I think it's evolved, but at one point it's like $1 per solve for Fin as an example. Thinking through like kind of switching to the buyer, like, are you seeing anything on the buyer side? Like, are buyers preferring the like outcome based pricing? Kind of directly to tie to the success of me using that thing, or are they still more comfortable buying like I know exactly how much I'm going to pay, every month, week, year, kind of a very known line item in my budget.
Things are evolving really fast here, and my sense is enterprises much prefer predictability. SMBs are much more open to newer pricing models. But in general, I think part of the trend is, hey, is this something that is oriented towards revenue or maybe cost and time savings? If it's oriented towards revenue, there's a lot of appetite towards outcome-based pricing models, especially if what you're bringing on is really incremental above and beyond what we would do so far. That way it's more like a Stripe, which charges, a 2.9%, whatever it is, transaction fee on revenue. And they claim like, hey, they can help drive an uplift in revenue, or, PayPal has similar models. But if your product touches revenue generation, I think there's a lot more appetite there. And for your customers, it means they're only paying if they're seeing real results, if they're seeing uplift in revenue. And so they're comfortable paying some of that as essentially the share for you for driving that, but they also know they don't want to pay for it or budget a huge amount up front if it's not going to deliver that revenue uplift. So say that's an area, and we invested in a company called ChargeFlow at OpenView that does chargeback management, which is a much larger category than a lot of people think, and there's so much money left on the table through fraudulent chargebacks. And so they charge about 25% of whatever incremental revenue they are able to generate from fraudulent chargebacks. And that model is just seen as a win-win. And the alternative for customers is like spending a big retainer up front, even though you've already lost the money because the credit card company or whatever bank is withholding that money from you. So now you're essentially double charged for a product that you
Yeah.
delivered to a customer, and it's very painful. But then, yeah, if I look at it, there's an interesting phenomenon, and I think the customer support industry is maybe a good case study where these next generation pricing models can be kind of unthinkable, or you're like, hey, this is never going to happen in my industry. And then you see someone like an Intercom doing it. The response is really great because the pricing is partly a kind of positioning and storytelling exercise. And so if you're able to say, hey, we're only going to charge when we give you real results, and we're going to focus all of our efforts on getting you better and better results, that is a pretty powerful message that you're willing to stand behind your product and that you're willing to kind of um, just share in a lot of risk with your customer. And so I think that that message from a marketing standpoint resonates really well, and it starts to have buyers asking, well, like, why wouldn't vendor X offer outcome-based pricing? Are you not standing by your product? Do you actually have worse results than this vendor? And so you start seeing a lot of competition for folks having to at least communicate that they're willing to offer that, even if it wasn't their preference. And so in the case of customer support, I mean, we see Sierra now doing outcome-based pricing, Zendesk doing it. We see Decagon offering it as well. But then I think what happens over time is like part of it's a marketing play where you communicate that you can offer outcome-based pricing, but then customers still prefer the predictability of something that's maybe more like per conversation pricing in the case of a Decagon or a Salesforce or others. And so I think that the takeaway for folks here is think about whether you can support multiple models for a customer. I know that might require some billing headaches, some quoting headaches, sales training, and so on. But think about whether you can offer multiple models and really be forward thinking about where your product is going and where your customers are going because you don't want to find yourself flat footed if the industry changes pretty quickly.
Yeah, awesome. We'd love to switch gears. We talked about AI. Our big theme this year is relationships and thrive through connection. Our whole thesis is uh, relationships have always been important in venture in company building, and they're going to be even more so now that we're AI-ifying a lot of our work. I would love to talk about founder support in particular for our audience, both founders and investors. We actually have a marketer on our team now who was actually a former OpenView portfolio company, and he said that you're always willing to help and support your teams and portfolio companies, no matter how big or small, which is really cool to hear. And a testament to you, Kyle. Are there any consistent support needs you've seen um, over the years of supporting companies for the last decade? Is it like go to market? Is it in particular what parts of go to market? Is it kind of depend on the stage or team? Where do you see a lot of the needs come from founders and operators?
Yeah, it's always funny. I think this sort of value add in venture or growth equity. It's a meme for a reason. I think there's a lot of firms that market having something, and then the reality is it's not really there, and there's maybe some taking credit for company success rather than actually driving that. So I think there's a ton of skepticism in the industry. But at the same time, capital is kind of a commodity, and everyone can offer capital, and so funds have to say what else are they bringing to the table beyond just capital. And I do think the needs of companies varies a bit in their life cycle. And so if I think about where I've historically played, it's usually in that 1 to 5 million annual recurring revenue bucket. And so folks have a product in market, they're generating revenue, they're relatively early in hiring sales and marketing, but they have some proof points and some repeatability around that. And now it's about, how quickly can they acquire and retain more of the best customers, and then also how quickly can they hire the best talent internally. And so I think, if you are investing in a similar place or folks are thinking about a similar place, um, talent is probably the low-hanging fruit. And so all of these companies need to hire people, and they don't have the uh, kind of biggest talent brand in the market. They might even not have an in-house recruiter, and so they might be relying on a mix of like internal team time plus the occasional agency. And so the ability to help these companies with hiring, particularly leadership hiring, ends up being just something that just about every company needs. And so a lot of funds have offered that. And I think that some have done a really good job at that model. And there's even some recruiting agencies that are now also investors and have had funds because that's sort of their differentiation or their wedge in is that they offer really powerful recruiting support. But there's also some conflicts of interest, right? Like, do you really want your investor being the one hiring for you? Are they going to help hire who they want to hire as opposed to who you want to hire? Do they really have the best feel of candidates in your specific geo and your specific industry? Are you feeling obligated to use them, right? There's a lot to unpack there. What I see increasingly of interest for companies is that people want access to a great network. Now, I think that should be table stakes in firms, but anyone that you should be wanting to contact, whether that's certain customers, advisors, experts in a certain area, your funds should have a Rolodex of some of the best people to plug into the business. And that can save you a lot of time of getting access to the right people to help you grow your business and essentially being able to make sure these are vetted in some way. So that network and kind of access to a community should be pretty top of mind. I think customer intros are an area where some funds have focused. If there's consistency around like, hey, we only invest in security products or we only invest in products like X, you could build out a pretty vetted network of buyers in that space that might be interested. Challenge is like, are these really qualified buyers? Are they just doing a favor to the fund for taking a meeting? It's a bit of a question mark, but for some of them, it is real. And then the final area is the go-to-market support, and that's the area that I've personally focused on and leaned into under this concept of companies are really trying to build out a repeatable go-to-market at the stage that I play. But that's I think hard to do at scale. I think that there's so much nuance across businesses and so much change that happens within a business. So it's really hard to do that if you've got like 20 to 30 new investments a year or 100 new investments a year. I think it ends up needing to be a little bit more bespoke. And I think that ideally that breaks down into specific service offerings or SKUs. So it's not just like, let me know how I can be helpful, but you can actually go to the company and say, hey, if you need help on pricing, running a pricing study, if you need help on identifying your best ideal customer profiles and building that ideal account list, if you need help with X, like we are an API call away essentially from delivering that service. I think that's what can really take the support from lip service to actually delivering real value for founders.
Yeah. Um, has being a creator um, helped you build more empathy for the founder journey now that you're doing this and have the newsletter that you're investing heavily into? Like anything you've learned um, over the past few years about the founder journey that's kind of changed your own mental models and outlook?
Yeah, well, so on the creator side, yeah, I publish the Growth Unhinged newsletter every week. The team is, if people think that it's like an actual team, and they're like, "Oh, loop in your editor, loop in X." It's like, nope, that's all, that's all me. And it's this kind of as uh, it's a passion project and it's something that allows me to actually kind of get my hands dirty with understanding trends, understanding what's top of mind for folks, and also just growing a thing efficiently without spending outside money. So I've grown it to 70,000 subscribers, north of 40% open rate with $0 spend on outside marketing, which has been pretty cool. But I think that the big thing for me with it is uh, I treat content as a flywheel, and I think that more people need to be thinking that way, especially around pipeline and channels. There's a lot of things that people do that are very one-off. It's like, oh, we're going to write this piece of content and then we're going to promote it, or we're going to run this marketing campaign and then we'll move on to the next campaign. We're going to run this paid ad. And to me, that a lot of times those can create some short-term boosts in growth, but they're not very sustainable. It ends up pushing the team on this sort of activity treadmill of like doing more and more and more, and then you look back and it's all disconnected and isn't really driving value, and isn't really creating a brand around your product. The approach I take, with this flywheel approach is it starts with having a lot of founder conversations. I'm talking to 10, maybe 20 founders in a given week, seeing what's top of mind, seeing what questions they're asking. And in many cases, I just start getting the same questions come up again and again. I'm like, I should really have like a perspective written down about this or like turn this into a framework if I'm kind of answering this so many times. And so then I'll take those questions. I have a massive backlog in Google Sheets of all of these topic ideas that come up, and I'll start with a LinkedIn post. And that's my way of just taking the kind of kernel of the idea or the concept, putting it out there and turning and creating a conversation around it. And those LinkedIn posts, many of them don't take off. Like there's not a whole lot of interest around it, but some do. And for the ones that do, I'll maybe have like 50 plus comments plus people shooting me DMs about it, and oftentimes end up getting a lot of insights or additional perspective from experts that have thought more about the problem than I have. And so if I see that there's a lot of appetite and conversation around the topic, I'll often go deeper and often even interview those folks that have reached out and then write a full piece for Growth Unhinged about that topic. Now, then, obviously, I share those back on LinkedIn, which then continues to kind of create more of an audience around it. I also, found as the community grows and as the newsletter grows, more of these experts want to submit their own bylines, or they're like, hey, I saw you published about X. I've actually just implemented something similar at my company. Would love to share the story of doing that. And so it starts to pull in all of these other people. And then that makes me a lot smarter and also gives me access to these people that founders will want to learn from because they know more about the problem than I do. And as you can tell, then that creates more founder conversations and allows me to offer more value to founders. And the more you can think of this as, a flywheel where the content creation and distribution are on equal footing and it's kind of built with and for a community. I just think that makes it feel a lot more meaningful and it drives way better results in the long run.
You mentioned LinkedIn, you mentioned Flywheel, you mentioned email, um, all channels that I think are evolving quickly, which is pretty interesting. So, but something we're thinking about every day right now is organic search, right? Where is organic search heading as channel as AI is delivering more exact answers either in the model itself or when you go into Google, it's going to give you the answer up top. Like, how are you see? I guess my question is the founders and companies are supporting and talking to. How are they successfully transitioning or diversifying off of organic search? Any things or themes you're seeing emerging there?
Yeah, I mean, I would start by saying like I think some of the trends around organic search, like I won't say they're overblown, but the impacts aren't happening as dramatically as a lot of people think that they are. And so there's still a lot of organic search and a lot of search traffic. And I personally see probably 10x more search traffic than I see traffic via AI search engines like a ChatGPT or Perplexity. And so I still wouldn't go like, oh, search is dead. We have to go towards like AI engine optimization or whatever. Um, but that said, like there are really meaningful declines, especially at certain companies. I think there was a viral set of posts about HubSpot's blog traffic decline, for example. I think the folks that are hurt the most are the ones where their content ends up being in a featured snippet in Google where there's no link, and people essentially can get an answer to their question without going and reading more. So they never land on your site. They never really get nurtured in your funnel and so on. And so that top of funnel content that's like really low intent traffic, people just trying to get educated on the space, really generic stuff. That's the first that's gotten essentially hit.
Mhm.
And honestly, like that stuff was never really that valuable to buyers in the first place. And the conversion was already very low on those pages. And so traffic often takes a hit as those pages stop generating traffic for you. But it doesn't really hurt that much in terms of overall like leads or conversions through the funnel, in my experience, because it just wasn't attracting that quality of an audience. When I led marketing at OpenView, we had this page on our blog that was like a sample daily report to your SDR manager. I don't know why, but that was our number one blog post for like years in like like just an insane traffic volume. That was not towards our target audience.
Right.
That was not valuable to just about anyone. And so when like we stopped refreshing that, of course, like we stopped focusing on that. But your page view count takes a hit when things like that stop performing. But again, just like, are you measuring page views or on your site, or are you measuring results from that traffic? And so if you're leaning away from top of funnel, where I would encourage people to still invest in is more middle funnel content. So things like comparison pages can actually be really helpful, because those are things that help you position your company and what you do. And then some of the AI engines now all of a sudden are reading that content too, and they understand what's different about your product compared to other products. So some of this deeper content that educates buyers is really helpful. I also think for a lot of companies, there's a lot of role for content educating people about how to buy AI products, how to make a business case internally, how to measure success, how to compare vendors. Most people just don't know how to buy products in your category. And so if you can essentially write the RFP for your buyers, I think it will put you in a really great position to win. And again, it's more thoughtful, deeper content, more middle of the funnel, which I think also ends up having better results when it reaches your target audience.
Yeah. Speaking of that, writing the RFP, um, what other SaaS trends or garden market motions do you think like are underrated today? Like anything you're seeing where there's uh, some promise or people are experimenting in something that's new or anything you wanted to highlight?
Those trends that are underrated. I feel like it's so funny. Like, as soon as something is underrated, all of a sudden there's like hype about it working for one company, and then it's like dead.
Yeah.
I think that yeah, so some of the things I would flag, I do think this more of like ecosystem oriented marketing with that's sort of building a community, partnering with niche influencers and content creators in your space, creating sort of a surround sound around your buyers. I think that that's still underinvested in. I think part of it's just like there's not a built out way of reaching and engaging these people, like there is in B2C. Often the influential people have relatively small followings, but they're very influential in your space. And so people don't know the right like monetization models and ways to enable these people and ways to make it feel like a partnership as opposed to a sponsorship or an ad. But I think that like ecosystem oriented marketing is where a number of folks are having success right now. Uh, and then I found there's still an opportunity for some product led plays. I think that one of the actually interesting ways of using some of these vibe coding tools that are out there is that you can offer products as content for your buyers. So you can build things that are for free tools and you can build them really, really quickly. And these are surprisingly powerful tools that bring people into your product and offer real value. And so it's sort of an evolution of content marketing. It's sort of like product as content
Mhm.
marketing. I still think there's some interesting stuff there. And then there's ways to leverage AI in go to market to make it more efficient. I think one of the things that I find personally really valuable right now is more of this in sort of next generation of account based marketing and signal based selling. So it used to be pretty untenable to do anything account based if your deal sizes were like under 100K. It was just really painful to figure out who the accounts were, what was the contact information, and like run these campaigns. You're often having high value offers to these people. I think now that data is all commoditized, and so you should know exactly who's in your target market. There's no excuse to not have a list of your best target customers right now, for at both the account level and the buyer level. Uh, you should know where those people are in the journey with you. Are they aware of you? Are they engaging with your content? Are they attending your webinars? Are they listening to your podcast? And so on. And then you should also be able to be collecting signals around intent that allow you to orchestrate go to market. So are they landing on your website, but not filling out a form? If so, that's actually a great opportunity to go outbound to them because you know they're interested in your value proposition. But there's a kind of dozens and dozens of other signals that you might think about. And the access to this data is commoditized. The access to the accounts you care about is widely available, and it actually allows you to reach the right people at the right time with the right message based on what you know about them. And so it's sort of being able to use AI and automation without making it spray and pray.
Yeah. What's old is new. Well, yeah, what's old is new, as they say. Um, awesome. This has been super helpful, Kyle. One kind of last question for you as we navigate relationships and thrive through connection this year. What's one professional relationship that's changed the trajectory of your professional life?
That's uh, that's a great question. I have to say, for me, it was Liz Kane, now Liz Christo, from OpenView. She's the one who hired me at OpenView. She's now a partner at Stage Two Capital. Uh, she was really the best manager that like you could ever have. One of those people that was available instantly whenever you needed her, but would also give a ton of free reign to try stuff out, learn on my own, take on more responsibility. And it's that balance is actually just extremely rare to find, of the supportiveness, but also the ability to kind of grow and take on more. And so she's still someone I'm close with to this day, even though I think she hired me like 10 years ago, but I would have never joined the industry without her.
Amazing. Shout out to Liz. Kyle, thanks so much for joining us, being part of our community and helping founders and investors alike with Visible. We'll see you out in the market, and appreciate your time today.
Sounds like a plan. Thanks, Mike.
See ya.